Hello all of you knowledge seekers, and welcome back to Knowledge with Alar. In this episode we are continuing with Modern Value Investing by Sven Carlin. So let's continue with Modern Value Investing by Sven Carlin, Chapter 4. In this video we're going to discuss taxes and why you shouldn't be afraid of them, about stock price movement versus the actual movement of the company's fundamentals, about being an optimist when it comes to the market, about theory of reflexivity, about failability and investing, about reflexivity and the financial market, about how to apply reflexivity within value investing, the focus on the stock price, a little bit about the Wall Street and its fees and interests, about Wall Street's short-term mindset and financial innovations, and then a little bit about what will happen in the book 2 of Modern Value Investing. So first let's talk about a little bit about taxes. Nobody likes to pay taxes, but as Benjamin Disraeli has said really nicely, there are only two certainties in life. Those are taxes and death. So taxes differ a lot depending on in which country you live. In Estonia there is a fixed income tax which is 20%. I know it can vary depending on where you live, but the basis is the same. You have to take taxes into account for if you're investing. So you really shouldn't be afraid to pay taxes just to prolong your investments or whatever. So let's say if you're invested 100 euros and you're up 100%, so you have 200 euros. Now if you pay your taxes, you end up with 180 euros, and you lose 20 euros out of that. So let's say you're not going to sell because you don't want to pay taxes, but if you did your valuation to the company at 100 and it goes to 200, then it's not a bargain anymore. It might be too expensive for you, so it might be a good idea to sell your investment and take the 80 euros profit you can take from it and invest it somewhere else which is cheap. So in the long run, if you pay taxes 20 euros and you lose 20 euros, so to say, but you could lose so much more if the value drops to back to 100 or even 160, then you're gonna be a loser. Now, but if you sell and you take the 180 that you can get after paying taxes, you can reinvest it into something else that is a bargain, and you can make another 80 euros profit by doing that. So keep that in mind while investing. Really learn about taxes in your area where you invest, so you know what might happen to you if you sell something or if you buy something or if you get dividends. Just really learn the system so you know not to lose. So the point number 2 in chapter 4 is distinguishing the price of the stock and the real intrinsic value behind the company. So if you're comparing the stock price to the company's intrinsic value, think like this. Are you going to buy food tomorrow no matter what happens on the market? Or are you still buying clothes? Are you still paying electricity? Are you still going to use your phone? Probably the answer to those questions is yes. So you really have to think rationally like this every time the stock prices drop and see, is the market being irrational, or is there really a fundamental change in the company you are invested in? The author brings out a nice example from 2009, and the example is Pfizer Pharmaceuticals. The prices dropped 53% during the crisis, but is it logical that people stop buying medicine just because the stock market is cheap? Probably not. And that's exactly what happened. During the last economic crisis, Pfizer pharmaceuticals actually was really stable. They still had the same profits, the same margins, everything. They just lost the value at the stock market. So when you invested during the downtime, in the long run, you really would have won a big time. You can really find good bargains any time in the market. You just have to do a lot of research, and you have to differentiate between the price and the intrinsic value. Then you can see if the market is being irrational, or is there really something wrong behind the scenes, you know. Just you have to do a lot of research. When everyone is buying, the market usually gets really ecstatic and the prices go way up. The same happens if the market gets pessimistic. People start to sell no matter what happens because they're really afraid and they want to bail out as soon as possible so they don't lose everything. But that's just the market being irrational. If you do your research properly, then you really know if your investments really have value or just an irrational stock price. If you're seeking value in all your investments, you can do really well, even through the recessions. You have to truly believe that people will keep on living their lives no matter what happens. Yeah, there might be some harder times, but people will go on living and the market will bounce back eventually. So if you know your investments, then you should be safe. The author really wants to teach the aspects of technical and psychological ways in value investing, and if you stick with my channel, you can learn these things alongside with me. The next paragraph in this book is about being optimistical about investing, and that it is really crucial to stay optimistical throughout the down times. You really have to be optimistical about your investments, because if you do your research and you know these companies and you know why you bought them, and now let's say the stock prices start dropping and you see the fundamentals that really nothing has changed, and you can be confident that it will bounce back if it maybe takes a few years, but the fundamentals are good and the company is doing really well and it's being rational and everything like that. So you have to be rational as well, because there is a reason why you invested in that company, and if the stock prices drop, it's a really good opportunity to buy more if you know that the lying fundamentals about that company are good. If the stock markets drop, it is so much easier to find bargains, so you really have to start looking again when the markets are down. You can find really good companies that now are undervalued. You have to keep in mind that the economy runs in cycles. It's just in human nature that everything is cyclical. When everything goes well, people tend to overspend. And the same goes the other way. If things start to go bad, people start to save money and not spend so much. And that all reflects on the market, because if everything is going well, people just invest more. And if things go badly, people start taking their money out without thinking. Markets are irrational. It's just the way it is. But because of the irrationality, it cannot be maintained for a long time. The market cannot rise forever. As the saying goes, it cannot fall forever. So you have to keep that in mind and be rational about doing your decisions, because there is going to be market shifts in time, and you really just have to account for it when you're investing. And usually when the market is down for some time and it shifts back up, it usually shoots higher than before, and that is just the way it is, because governments keep pushing different monetary policies to enliven the economy again, and it usually goes higher than before. So in the long run, a recession might even be good for you if you're a value investing and you can buy companies on the cheap when the markets are down, and just wait a bit and it will all bounce back and you will make a nice return. So the next point is the theory of reflexivity and value investing. A nice quote by Sven Carlin. The stock price can at times significantly influence the value of a business. Investors must not lose sight of its possibility. Behavioral finance studies how people's psychology will affect the market and how often people are irrational. And this is what creates opportunities for value investors. If everyone would be rational, there would be no bargains on the market ever, because all the prices would be rational and same as the intrinsic value of a company, but that is never the case. The theory of reflexivity was created by George Soros, one of the greatest investors of all time. His long-time investment returns have been even higher than Warren Buffett's. He goes one step further than Buffett while investing, and he takes the theory of reflexivity into account. He says that the reflexivity can affect the companies, be it either good or bad, and it can push the stock prices either up or down. Now let's say that the stock market of some company starts dropping, and it drops to a certain level, and now let's say that the same company needs to get a loan to start operating on another venture or whatever, and the banks say that, but your stock prices are so low, we can't lend you any money. So even if the prices started dropping on some irrational reason, and it dropped beyond a certain point that the creditors won't lend them any more money, then the irrationality of the market can lead to the intrinsic value of the company to starting to drop. So there is a connection between the irrational market and the companies as well, and that is the most irrational thing in the world, I believe. So when you are doing your intrinsic value about a company and all the research, and you see that the company is trading at a bargain price, you really have to look behind the scenes at what is going on. Is there something else in play? Do they need to invest more money, and do they need to take out loans and all that? And that might add a bit of technicality to the valuations. The prices in the market go up and down all the time, and it is just the way it is. And if things start to fall and everything is going to get negative, and it all starts to influence people on making their decisions and influence even the companies on giving out loans, it all creates instability in the market. If you keep saying that something is bad and bad and bad, then everyone starts to believe it is bad, and it will all lead to making the wrong actions. The author brings a nice example on parenting. If you tell your child he is bad every single day, then when he grows up, he is going to be bad, because that is what he is thought to believe. Now, the previous example was how bad impressions might lead to the negative effect on intrinsic value, but the same can apply in the other way. If you take Tesla, for example, Tesla's stock price has been pushed up and up and up because everyone is believing in the company, and they get more investments all the time because they believe in the idea behind the company. But in actuality, the company has never earned a profit, so it's really difficult situation, and that can really push the book value of the company up. Like, there are so many tech companies today that are only beginning, but their valuations are over $1 billion, and that is really difficult to evaluate. The only basic value is that you believe that the company will excel in the future and will get to the level they are promising they will get, but can you really be sure? Being a value investor, you really have to be careful about these types of investments. It is sometimes smart to, if you believe that, let's say, Tesla will succeed, it would be maybe smarter if you invest in electric vehicles altogether. So maybe Tesla will succeed, maybe not, maybe Volkswagen or whatever will beat the market, who knows? You can't see the future. So if you want to invest in the electric vehicles, think a little about what electric vehicles are using, like copper or whatever smaller metals, or it might be smarter to invest in that. So when Tesla or some other company will succeed in the electric vehicle market, then you will gain no matter what. And because of miners like these, they pay usually dividends, and the business will go on even if the electric vehicle market won't succeed. You won't lose money in the long run, and you might gain money because electricity is used elsewhere as well, not just electric vehicles. So even if the electric vehicle market doesn't succeed, you can still make decent profits. So I will read a bit from the book about reflexivity. Be the reflexivity either positive or negative, it is extremely important for a value investor. Even if something looks like a bargain, the low price can really push creditors from lending or force the company to raise capital in extremely dilutive scenarios that can significantly negatively affect the initial presumed value and margin of safety in an investment. So keep that in mind. So the next paragraph in the book is called Fallibility and Investing. So fallibility is strictly related to reflexivity. Because the world is too complex to comprehend, therefore all our conclusions are distorted. We always try to simplify everything to get a grasp of it in our small minds. So to make this idea a bit simpler, think about it like this. Like a statement, it is raining outside. It can either be true or false. But statements like cryptocurrencies are revolutionary, they can be either true or false, or we simply don't know yet. The truth of the statement will be seen when we see the effects it has on the world. So we can't know it at this point of time, but we will know it in the future. So reflexivity can be understood by feedback loops. It can be either positive or negative. A positive feedback loop will drive the participants' views further apart, and the negative one will bring them closer together. And both of these will create self-reinforcing cycles. And it is important to understand that these cycles cannot go on forever, because the views will become so far from reality, and the participants would understand that is not logical what they are doing or thinking. And then a correction would start. And the feedback loop has an effect on actual events. Thus, this is all reflected. And it all leads toward this equilibrium. And these self-reinforcing cycles create boom-bust processes in the market, which can lead to bubbles on financial markets. And let's say it like this. Can you be 100% sure that the Fed members are correctly interpreting how the financial system works? Is what they are doing the best way to act? At the moment, you might agree, you might disagree. And if the facts are going to be so far away from the truth and that people will start to realize it, that's when the cycle will reverse. So right now the Fed is pushing money into the system, and if a point comes that won't make sense anymore and it reverses, it might create the economical downturn, so there might come a recession. So in value investing, it is crucial to take these points into account, and when you are doing research on a company, it is so important that you seek out as many margins of safety as you can to be safe no matter what happens in the market. So you know that the company can't fall to zero, or if it can, the percentage of that happening is really low. And how all that reflexivity leads to financial markets is that the prices are always distorted toward the underlying fundamentals, where the distortions can be small or significant. And the financial markets can affect the fundamentals they are supposed to reflect. And that is why the theory of reflexivity goes in one step further than just behavioral finance. Behavioral finance just states that markets are irrational, but the theory of reflexivity states that if the markets are irrational for a long time, it can alter the real fundamentals of a company. So how to use theory of reflexivity within value investing? So you basically have to look for catalysts in the market that will turn the cycle. So George Soros says that the bubbles are asymmetrical in shape. So a boom cycle usually takes a bit longer to happen and will last for a longer time, while a bust usually happens really quickly and reverses faster. And the length and strength of each of these cycles is unpredictable. But there is an internal logic to the sequence of stages. So the sequence is predictable, but even that can be terminated by government's intervention, quantitative easing. So if you apply the theory of reflexivity, you will rush to buy when you see a bubble forming, because the trend is usually self-reinforcing, and you will rush to sell when there is much twilight. Thus, you cannot expect the market to adjust itself according to the fundamentals, as looking at fundamentals is not the way to make money in the short term. So this paragraph is really technical and quite difficult to understand, so I really recommend you to get the book. You can find a link down below. I will add my affiliate link and you can buy Modern Value Investing. I really suggest you to read this through at least a couple of times to really understand it. It is quite an interesting subject, so really check it out. So next in the book is a paragraph about shareholder value creation and destruction by doing buybacks and corporate management and all that. There is a nice quote by Carl Icahn. Quote, "Literally half of the board is dozing off, the other half is reading the Wall Street Journal, and they put slides up a lot and nobody can understand the slides. When it gets dark, they all doze off." So when shareholders judge management, they look at whether the bottom line is positive or negative and in line with what the competition is doing. Nobody is assessing whether it could have been better. As most stocks are owned by indexes and pension funds that own just a bit of each company, corporate managers don't really have tight control on them, and as long as things go relatively well, there is no problem for them. However, the misalignment of the management's interests with the investors' interests will lead to huge future turmoil. So let's say that the company's earnings are 90. Yes, it is better than being minus 10, but could they have been 190? That is an important thing to keep in mind. And if you look at the Standard & Poor 500 earnings from 2007 to 2017, you can see that the earnings have stayed flat for 10 years. They haven't gone anywhere. And that is completely illogical because the interest rates are at record lows. The global economy has been growing for 10 years, but the earnings of 500 largest American companies have gone nowhere. And that is basically because the focus is on the short-term stock price and not the fundamentals of the company. People think that a high stock price is good. It is only good when you are selling. If you are accumulating assets for retirement or whatever, then lower prices are better for you because you can acquire more during the long run. But now what corporate is doing is they're doing buybacks and not growing their business. And when they are doing buybacks at higher market valuations, they are actually destroying value in the long run. Yes, shortly they will push the stock price up, but in the long run it is really destructive on the companies. From 2000 and 2017, Standard & Poor have actually spent 7.16 trillion on buybacks and dividends, while they have been earning only 6.8 trillion. So they're paying out more than they are actually making from the companies. This is all based on the cheap loans that they are taking out. So when things turn, everything will change because they can't keep doing what they are doing, they have been doing for the last 10 years. And because the buybacks have been made no matter what the book value of the company is, that is just the worst thing to do. Yes, if you do buybacks when the company is valued below intrinsic value, then that is a good deal. They are simply creating value for investors. But if they do it in reverse, they are just destroying value. So basically, an easy example on this is, let's say you want to build a house and you figure out that building this house will cost you $1 million, okay? And your next door neighbor is selling a house, same value, and he's selling it for 600,000. It's a good deal, right? But now, what is happening on Standard & Poor 500 companies at the moment is they have a house that is worth 1 million and they are buying those at 3 million. So they are really destroying value by just buying really expensive assets. As a value investor, you should always look for companies that are doing buybacks only when the stock price is trading below book value. This does the opposite of what is happening on the S&P, and it really will increase shareholder value. There was a research done by Robert Aries and Michael Olenek from Intrinsic, and they say that when companies are doing buybacks when the stock price is above book value, then that is basically corporate suicide. And that is just what is happening all over the world at the moment, and that is just crazy. Warren Buffett doesn't do any buybacks when the price to book value is above 1.2. So he's a smart guy, you should be also. So the next paragraph in this book is beware of the Wall Street's interest and fees. When you take into account the fees and the interests of Wall Street, then you can see that there isn't much left over for small investors. That is the reason why an average investor achieves much lower returns than the market. Most of the returns just goes for paying fees. And it's in Wall Street's best interest to receive these fees and not make long-term returns for its clients. And that's just the way it is. It's just Wall Street gets paid on how much they do and not how well they do. And Wall Street tends to jump from one investment to another, and in the process of this they are just making fees, and it can be really destructive for an investor. Like in the last economic crash, the market was flooded with different types of debt. There were these complex systems which were made up of mortgages, and it all went bust. And today the market is flooded with different ETFs, and it's basically the same story. So you really have to be careful where you invest and what are your fees and what are the long-term risks. And as at the moment everyone is saying that ETFs are really like a genius way to invest, that it is so safe because it's so diversified. There is a really nice saying by Seth Klarman, quote, "What appears to be new and improved today may prove to be flawed or even fallacious tomorrow." So really think about it. Really think what happened during the last economical crisis. If you haven't seen the movie The Big Short, you should watch it. It's a really good insight into long-term investing and all these different types of new fancy investments like ETFs are at the moment. And you think like what is happening behind the scenes in these scenarios. And Wall Street is just never happy with success. It will always look for the next commission. You have to be very aware that your investment goals are in line with the ones of your financial advisor. So that was chapter 4 of Modern Value Investing by Sven Carlin. This paragraph was the most difficult of this whole book, but I really recommend you to get through this at least a couple of times. Like I said before, I will add my affiliate link down below. So if you like my channel and you like this book, I really suggest you use it so I can get a little kickback from it and I can keep continuing doing what I like doing and to bring you more books in the future. Now in the next episode I will start discussing the book 2 of Modern Value Investing, and that is the technical value investing part. So then we will start to go through the 25 tools that are used in this book, and yeah, more about that in the next video. So thank you guys so much for watching. I really hope you liked this video. If you did like it, please give me a thumbs up and subscribe to my channel, and leave me a comment down below. I'm really eager to answer to all your questions, and let's see you in the next video. Bye.